Welcome back to the Gold Newsletter channel. My name is Kai Hoffmann. I'm the @JR Mining Guy on Twitter and the CEO of the SOAR Financial Group. And we have a company introduction and a bit of a news special for you today because I'm joined by the gentleman over at Goldshore Resources. They put out a fantastic, or not a fantastic, but a big resource update out this week. It's an update from the 2023 resource. They're sitting at 6.7 million ounces now combined. I can't say it, they can't, because I can do the math and add it together. It's not really NI 43-101 compliant if the company does it, but we can. 1.5 million of that is in the indicated category, quite confident category there. 5.2 million are in the inferred category. And we're going to talk to the gentleman about how that resource came together and, of course, what are the next steps for the company now. And let me bring the gentleman on the screen here. We have Brett Richards and Pete Flindell joining us. Brett is the president and CEO. Pete is the VP Exploration. Gentlemen, thank you so much for joining us.
Kai, thanks for having us.
Absolutely. Yeah, no, you're welcome. And why don't we start with a bit of a high-level overview of the company, Brett, because it's the first time here on the Gold Newsletter channel for Goldshore. Let's catch everybody up. Who is Goldshore and what are you all about?
Yeah, for sure. Goldshore has been around since June of 2021. We acquired the Moss Gold project from Wesdome Gold Mines for shares and cash. And we've been working the project now for over 3 years. Both conducting a large exploration program and also environmental baseline work with regards to future permitting. We have drilled about 80,000 meters on the project. It comes with 150,000 meters of historical drilling and a 4 million ounce historical resource. So our goal was to not only validate that resource, but take it through its next steps of development to increase the size and the scale of the project. It's located 100 kilometers west of Thunder Bay, and we have all of the infrastructure needed to potentially build a really large mining camp here. So, we've been at it now for quite some time, and we've made a lot of strides.
No, fantastic. Yeah, no, that's a good introduction to the company. Appreciate that, Brett. Of course, big news this week, and sort of the culmination of all the efforts is that resource update that you put out just about 24 hours ago here. Run us through that update, and what are some of the highlights there, Pete?
Yeah, hi. Thanks for having me on, Kai. It's been the culmination of a lot of work. I'd like to preface everything by just saying this is not our first rodeo. While my title is VP Exploration, I'm really more of a projects guy. Brett and I have a long history of taking exploration projects and making them into a mine. So yes, this is our first rodeo in Canada, but we've done this before and we've set the project up to get us to be a mine. So where we're at now, where we've come to over the last 2.5 years, is to take the little over 3 million ounces at Moss that we inherited, and the large inventory of 800,000 ounces at East Coldstream, which was not in a pit and therefore not an NI 43-101 compliant resource. Take those, understand where the gold is, why it's there, where it may extend to, understand what's happening with the low grade, and to build models that we can mine to. And as Brett said, at the same time, we're doing our environmental baseline work, doing everything that we need to do to get this project permitted and into a mine. So with respect to this resource, and apologies if I'm going ahead here a little bit, but the big change in this resource over the previous resources is that we have fully constrained all of the grade. Previously, we put out a 6 million ounce inferred resource because we wanted to tell the market the quantum or the caliber of the resource. This time around, it's about defining everything better, and it's all contained within these dozens of parallel structures that are gold mineralized, and this is where we've got to now.
Fantastic. Pete, let me follow up with a bit of a technical question just to simplify and understand. What does constraint mean in that regard, and how does that maybe put constraints on things?
Okay, fine. Yeah. So when we go to model a resource, if we have no boundaries to the gold mineralization, then the modeling process can just spray gold mineralization everywhere, and you end up with a lot more tons and probably at a lower grade. By containing or constraining or putting boundaries on the grade, we're making sure that we don't make tons that don't exist. And we're also, at the same time, separating what's effectively not mineralized or mineralized to a low degree with zones that are very well mineralized. This is why our grade increased in the resource.
Okay, that was one of the questions I had, is like, why did the grade increase? But
Yeah.
maybe you can sort of explain a little bit as well. What kind of constraints did you apply? Like, usually it's pit constraints. So like, what kind of factors went into that?
Well, there's the constraint in the modeling itself, which is a series of wireframes that basically define the geology, these shear zones. They were all developed using implicit modeling, so not a manual wireframe as we did before, but a computer-driven modeling of the structures. So this is why we have 94% of the tons and ounces sitting in these wireframes. And sorry, and the rest of the question.
No, just how you constrained it. Like, what kind
Yes,
of
sorry, that's right.
what you applied there?
Yes, so that's how we created the block model. And then for it to become NI 43101 compliant, we need to use the RPEEE definitions, which is to apply an open pit optimization to the model, and also to look at blocks that are potentially mineable by underground methods. So the open pit optimization utilized cost parameters that were derived in our PEA that we were running last year and decided to cut short. So they're real world costs. They apply directly to the project, and they're based on the project parameters. We also used the recoveries by flotation and leaching, which are 90% for Moss and 95% for East Coldstream. And finally, we used the gold price of $1,850, which is just the 3-year trailing average of gold, and that was what was recommended by the QP.
Okay. Well, you answered a lot of questions, just the last 2 sentences here that I had for you there, Pete. Well, which is good. So we don't necessarily have to duplicate them. But real quick, gold price used last 2023, it was $1,650, now $1,850. Purely just a function of gold price moving higher the last few months here.
Well, it's a trailing 3-year average, so you knock out all of those prices prior to 2020.
Okay. That makes sense. There's just a simple explanation for that, because,
Yes.
apples and oranges, I always like at least an explanation or understanding of how price changes or so come about here as well. So you upgraded some of the resource into indicated category.
Yes.
Run us a bit through that, and how did that work? How did that process look like? And maybe a bit of a cheeky question: why only 23% of the entire resource?
Sure. So we had Apex look at the question of our historical drill data set late last year, starting in October. And we really wanted to answer the question, is this historical data set usable or not? And what they were able to do was to focus within sort of a 40 to 70 meter range to localize the comparison between historical holes and our holes, and found that the populations are almost identical. Where they're not identical, where they fall apart, is below 0.35. And that's simply because historical holes were assayed to 0.01 ounces per ton, which converts over to 0.34, and therefore below detection limit becomes 0.17. And of course, much of that low grade was never sampled historically. So above the 0.35, our historical data set and our current data set, the drill holes that we have drilled, are virtually identical and within that 40 to 70 meter range. And this is why, to your answer, why 23%? That's the 23% basically has sufficient drill data within that 40 to 70 meter range. And outside of that, we don't have sufficient drill data, and therefore it's inferred, and we need further drilling or resampling of historical holes.
Okay, perfect. I think that sort of sums up the question about the resource, because I think all the questions now it's sort of leading or mentioning or sort of, what do you call it, coming back to what you just said at the end. We'll need further drilling. So I'm curious, maybe Brett as well, like how confident are you in that resource right now? Is it at a size where you feel confident taking the next step within, next milestone could be a PEA, PFS as well? Like how confident are you there if you wanted to break it down? Because let's do some simple math. You mentioned in your video on the website as well, 200,000 to 300,000 ounces, probably the optimal goal here. But if you break it down, the 1.5 million at 100% recovery, that's only 5 to 7 year mine life. I'm sure some juniors would be really happy with that. But putting NPV calculations and other economic metrics around it might make it a bit more challenging. So I'm curious, how confident are you with the current resource, and what are your plans maybe developing it further?
Yeah, I don't think you've taken a bit of a fractal leap here. I don't think we can jump that far ahead. I think what we need to do is say, hey, we've got 1.5 million ounces of indicated, 5.2 million ounces of inferred. We still need to drill this out, whether we infill the existing resource or we continue to step out and build inventory on a global basis. So that's a decision that we need to make sometime in the future. And it's really about what is going to deliver value to us. Is having a project on the existing resource, and we can use some of the inferred in a PEA, is having a project, is that the way to create value for shareholders? Or is building inventory and a big potential bull run coming, is that going to be rewarded more for our efforts? And the real answer is, after this resource update, we really don't have to make a decision just yet, because we are doing substantial amount of met test work for column testing for heap leach viability. And I think after we get the results of that, we'll end up having the answers on recovery on the metallurgical side of things as to what process we can use. Is it going to be flotation and heap leach? Is it going to be flotation, heap leach, stockpile? Is it going to be whole ore leach and stockpile? Is it going to be, the heap leach factor here really changes the dynamic of how we scope this project. So when those results come in kind of May, June of this year, we'll be able to sit down and say, okay, what are we drilling to? Are we going to drill this resource out and infill it? Are we going to step out and add inventory? Because I think we've demonstrated that we have a visible path to well over double-digit million ounce resource here, well over. I think it's it's our view, but we can show you mineralized areas of our land package that would have historical drill results with mineralization on them that we need to test, and that's the 36 targets that Pete has prioritized and that we're ready to go with when the market comes back. But we're trading, at $4 an ounce today. It costs us $10 or $15 an ounce to find them. So today, there's nothing we can do until our market cap reflects enough value for us to go out and raise money.
No, that's 36 targets, of course, is a lot of upside. The question is, though, as you mentioned, where's the inflection point? Right. Also, do you really need to show 10 million ounces in a resource? Doesn't matter what category, inferred most likely. Will the market even reward you for that? Right.
I don't know the answer to that, really.
Me neither. So that's why I'm wondering, where that is, right?
Yeah, that's the balance between a really, really high gold price and a really, really strong capital markets. Which one of those environments is going to create the most amount of value in either of those scenarios? If we're sitting with 12 or 15 million ounces at inferred, Are we going to get $20 an ounce for that? And is that worth more than 7 million, 8 million ounces, half of it indicated, putting a project around that? Is the inventory worth more than the project viability? That's what nobody can answer, and especially in this capital market environment where there's an uncoupling of gold equities to kind of historic norms. That's the first step. We have to calibrate and re-rate back to historic valuation norms on a categorical basis, whether it's an inferred, indicated, even P&P. So we need to be able to recalibrate that, and that's irrespective of gold price.
No, absolutely. The market needs to wake up to that. $4 an ounce for a project that's potentially viable is just not the right valuation metric. Absolutely. You mentioned you're doing met work right now, quite extensive met work. What other work are you doing in parallel as well? And it sounds like you're doing met work to a PFS or FS level even.
The one for me?
Yeah,
sure. So really, we're doing the heap leach test work at the moment. The reason for that is that when we did the PEA, we assumed 45% recovery on heap leach with low-grade mineralization. And the project, whether we did a whole ore leach on everything or whether we did a hybrid flotation leach and heap leaching of low grade, basically had very, very similar economics. It's one of the good things about this project is there are many ways to operate this project. But what we learned is if we can get heap leach recoveries above 50%, it's a game changer. Not only do we reduce the amount of tailings, we reduce the size of the mill that we need to build, so we reduce the initial capital. We also bring gold production forward. So, we can see a scenario here where we're producing, now admittedly adding inferred into this, we could be producing 300,000-400,000 ounces a year. We just need to get the numbers to back it up. And right now we don't know if heap leach is a goer, and that's why it's a priority, but it's a game changer if it works.
Real quick, and maybe it's a dummy question here because I'm not a technical guy, but you're assuming a 90% recovery in the resource, but heap leach you're looking at maybe 50%. So just explain to me how that sort of fits together, that and where that discrepancy comes from.
Right. So the 90% recovery comes from test work that we did on flotation and then leaching of the concentrate and tails. The test work actually came in at 93% for Moss and 98% for East Coldstream, but we factor those down because we have grade dilution and a number of other operating factors. The heap leach test work is all about the lower grade material, and typically heap leaches around the world, particularly if you look at dump leach in Nevada, it's really a low cost way to get the fast ounces out. You don't get all of the ounces, but you get the fast ounces out. That's the difference.
Gotcha. That makes sense. I wrote down in my notes as well that you paused the PEA process back in November. The question now is like, what's the status of the PEA, and what have you learned so far? And are you maybe going to skip the PEA process altogether and just jump right into PFS? Maybe getting ahead of myself here a little bit, but it's a question I was curious about.
Yeah, it's a good question, and we get asked it often. I think when we started the PEA with Ausenco on the mineral resource estimate we put out in April, we were thinking larger scale, order of magnitude. We gave them a 600 million capex threshold, and we wanted to see something put together that delivered a north of 30% IRR and had a 1-to-1 capex to NPV post-tax kind of ratio. And those are the parameters we kind of started with. And then they started going through the permutations of the potential processing methods, and volume seemed to kind of outweigh, looking at small volume and higher grade. So that's kind of where we went towards. We were well down the road, and there's a lot of work that goes on in a PEA that is very applicable for A, the future, or B, our mineral resource estimate now. So we come September, we paused that process because, hey, the market wasn't giving us value. We were trading at $3.50 an ounce. We still are. And we paused it and we said, hey, if the market doesn't want to see a $500, $600, $700 million project, what about a bootstrap, low capex, small volume project? Let's look at that. So we went back to the kind of the scenarios of permutations of processing, and we said, hey, you know what? We could potentially go down and use 4,000 or 5,000 ton a day option for flotation, and have a really, really kind of decent sized heap leach operation, which might be not as economically attractive as a high capex project, but still, above a 25% IRR threshold. So we had them go down that road, and then we paused again because, let's face it, the market still is not giving value for anything. The market's completely disconnected from where we are. I think what we want to do now is complete the heap leach test work, and from there, what we'll do is we'll determine a path to PEA, and that is going to be, we will start a PEA right away and start working on the existing resource, or we will defer a PEA and we will try and step out and drill the resource to a higher quantum, not necessarily a higher quality, but a higher quantum, and look to push out a PEA by, let's say, a year, but doing it on a much larger project. So those are the questions we're going to ask ourselves in early Q2. Once we start to get the results back from heap leaching, it'll guide us as to where we know we're going to go. And quite frankly, strategically, our board has to take a view as to where they think this market's going. As we said earlier, Kai, is inventory going to be rewarded, or is quality and speed to market and getting a project out there as soon as possible, cash flow, is that going to be rewarded sooner? I don't know the answer to that, because this is a market we've never been in before. In my 35 years, I've never seen market dynamics like this ever.
Yeah.
Kai, sorry.
Oh, yeah.
May I just add a additional comment on the PEA?
Go ahead.
One of the reasons why we started the PEA as early as we did is we wanted to understand the drivers for the permitting process. So, hydrology concerns, how do we manage the water on the project? Are there any issues with species at risk or fisheries that need special remediation? And also, we wanted to engage with our host communities on the various options that we have for site infrastructure. So getting ahead on that, and it's something that we can work with in the background and take time to do properly, rather than wait until the end of a PFS and then find that we've got 2 or 3 years of work to do. So that gives us a leg up, and that's just our experience of developing a mine is start some of these things early, because they'll pay dividends in the end.
Absolutely. No, it's probably time well used to figuring that out as well, and to progressing that as well, because it's usually not the most expensive part of the whole process. So which leads me sort of to my last question as well, because it wasn't my second question, which it usually is. Like, how much flexibility does your balance sheet afford you right now, Brad? And how much wiggle room is there? Usually cap structure is my second question on company introductions here.
Sure. We've got about 267 million outstanding. We raised 3.75 million back in late November. And the last quarter of last year was really about, let's put a strategy together to survive. And we brought in a strategic partner. We talked to a company called SAF Group out of Calgary and Vancouver, and they have agreed to kind of partner with us as a strategic partner. And some of their principals came into that financing, as did myself and others in management and the board. And we put together 3.75 million. We still have some flow through money to spend in 2024 as well. But the balance sheet looks solid right now. We got $4 million in the bank, and we have enough runway for 24 months of working capital. We're actually burning less than $60,000 a month on G&A. Management are on 25 and 50% salaries in most cases. And we've cut our staff to nothing. And I don't do any marketing, advertising, because in this marketplace, aside from you, Kai, but in this marketplace, really nothing is working because there's no liquidity, there's no pools of capital that are moving into our sector. And getting the story out to audiences like yours, which is extremely large and extremely close to this market, I think is ideal. I think that this is a medium I think will deliver success to not just us, but many mining companies.
Fantastic. No, I appreciate that, Brad. And maybe sort of put a bow around the conversation. What are the next steps now? You put out the resource, of course, as shareholders and investors, we're always greedy. We want the next press release, ideally with a high-grade VG hit, of course, tomorrow. But what are you working towards, and what can we expect next year?
Yeah, I think we can't really raise a lot of money for a big drill program. Like ideally, if we wanted to put together a strategy of drilling going forward based on a different market cap and different raising environment, we would probably raise 15 million this year and maybe 25 million next year. $40 million gets us to the next decision points in our, do we take this to feasibility study, at what size, at what scope, etc., and really brings up the quality of this resource. So that would ideally be, the next, I'll say 18 to 24 months of work that we would want to do. We simply can't do it at this share price. However, we are going to do some drilling this year, irrespective of big campaign. We are going to do some drilling up in Vanguard, our earn-in obligations with Thunder Gold. We'll be doing some drilling up there. Pete's going to do a lot of work on the ground this summer. Low cost, high intensity kind of manpower work with his very, very small team. And we're going to continue to advance our understanding of this deposit. I think the press we're going to be putting out is, yes, we will be putting out metallurgical test results. We will be doing corporate updates in half two to talk about where to from here. I said, are we going to drill this out or are we going to step it out? Those will be the decisions we share with the market, because one will lead to an early PEA, one will lead to a PEA next year. One may lead to a PFS and skip the PEA function because of our confidence level of this resource. But there's no denying what we have. We have the potential here for a tier one asset, and that's 10 million plus ounces, 500,000 plus ounces a year of production, and lower half of the cost curve and an upper quartile of the grade curve. We can tick all those boxes. We just need to prove it, and we're getting there. And these things take steps and takes time. And I think we're being kind of very smart with our money, and we're being very smart, kind of positioning ourselves as we're get ready for this run, because I think we're in for a very, very strong run.
Fantastic. Brad, Pete, thank you so much for your time. I think it was really insightful. It was a good overview of where Goldshore stands right now. Really appreciate a bit of a technical deeper dive as well on the resource. So appreciate the explanations there, Pete, on how the resource is constrained, how you developed it, and what went into it, of course, as well. So thanks so much for that, gentlemen. goldshoreresources.com for more information. And if you haven't done so, make sure to hit that subscribe and like button down below as well. Leave a comment, especially that like button is like, if you like our questions, if you like the content we're producing, hit that. Should we bring the company back more often? Let us know. We do want to hear from you. It helps us tremendously. Thanks so much for tuning in. We'll be back with lots more here on the Gold Newsletter channel. Thank you so much.